Joining us now to talk more on what to expect from the last trading days of the year, Scott Nations, President and Chief Investment Officer at NationsShares. Good morning, Scott. Good to see you. So just talk tactically about where we sit. We have this upward drift, pretty typical of year-end around the holidays. Where does that take us in the next few days, do you think, and beyond?
Well, I think Dom was right to focus first on interest rates. Listen, you don't have to be a genius to be a bull when interest rates are as low as they are. 10-year yield is more than 100 basis points lower now than it was this time a year ago at 1.9%. As long as it's below 2, then you don't really have to be that brave to buy stocks. So as long as interest rates remain low and as long as the yield curve remains uninverted, then I would continue to be a bull. There is one thing that is worrisome, though, and that is the option market is saying something that's a little bit ominous. If you look at the money implied volatility in the S&P space, it's really low. And that's what you would expect. You would expect that as we're making new highs and as we're in the middle of the holiday season. But crash protection has gotten very expensive. And that relationship is at an extreme for the last 52 weeks. So what's that say? It says if you look at the money implied volatility, nobody expects very much movement over the next 30 days. If you look at crash protection, they're saying, yeah, we don't expect much movement, but if we get some, it's going to be to the downside and it's going to be ugly.
Now, do you think you take that on face value and say that, in fact, people, smart money is positioning for some kind of big downside move, or is it just, I'm going to hold stocks through year end, things look like the trend is strong, maybe I'll just take out some insurance in case something gets out of hand to the downside?
That's a great protection, but at-the-money options are so cheap that if really all you wanted to do was buy insurance, with the S&P up nearly 40% if you include dividends, then you would just buy those really cheap at-the-money puts, and you get complete protection with no deductible. And so this is something very different, I think. I think this is people who realize that that interest rates are low, and that's been great, but maybe we've gotten into a little bit of a bubble. I think this is more of a trading thing than a protection thing.
You say if interest rates remain low, do you expect them to remain contained here?
Oh, the Fed has said that they're going to. I mean, we don't expect the Fed to do much of anything in 2020. I think that they should be raising rates because there's a bit of an asset bubble. Doesn't matter if it's equities or fixed income. And I think that's actually really dangerous. But the Federal Reserve has said, nope, we're not going to do anything in 2020 unless something changes dramatically.
That's from the Fed side, and you don't think that that the bond market's going to see things otherwise?
Well, the Fed is going to call the tune. Interest rates probably should be a little bit higher, but given what the Fed has said, I don't know why anybody would go crazy thinking that we're going to get back above 3% in the 10-year like we were.
Probably
again,
depends on whether or not
ago.
we're going to see wage inflation at some point with the employment numbers, right?
Yeah, that has been the question, right?
That'll drive the long end at some point, which will force, I would assume, the short end to.
And wouldn't we love a little wage inflation right now? That actually would be a great thing.
We've got a little, I guess. You probably want more. But so in other words, the point is you don't think the bond market is about to start sniffing out an inflation issue?
No, I don't think so. Not at all. I think part of the problem is the Fed is probably using a really antiquated measure of inflation, and they're not taking into account Amazon and everything else. But the Fed's just not going anywhere, unfortunately.